Hi everyone, me, Small Investor here. Today I'd like to share a concise table summarizing the stocks I reviewed over the past month. Before diving into first stock, let me just clarify, this is not financial advice. All stocks buy prices are based on my interpretation of financials and the risk I find reasonable for me personally. So, without further ado, let's dive into Louis Vuitton, our first stock. Now, before you get concerned about the buy price being 39% below the current market price, let me explain why this number is so low and how my process works. To make a return on your investment, you need a margin of safety. For me, this margin varies by stock. Here is how I calculate it. WACC, or weighted average cost of capital, is my required rate of return, and I set the minimum at 8%. On top of that, I add a margin of safety for two areas: cash flow calculations and enterprise value to revenue multiple. For Louis Vuitton, the WACC is at 9%, and I have added a 15% margin of safety for cash flow and 20% for enterprise value to revenue. These numbers will vary for each stock I review, so keep an eye on them as we go through the table. The buy price is an average derived from several valuation methods. If you'd like a deeper dive into any specific stock, let me know and I will gladly make a video for it. Now let's talk about returns. In the table you'll see two columns for returns. First is return on current stock price, which is stock price movement only. For Louis Vuitton, this shows a negative 1% returns, meaning we are expected on average to lose 1% each year if my assumptions are correct. For the second return, we add dividends. This increases the return for a stock to a barely positive return, assuming they maintain the current dividend payout. Dividends now have a yield of 2%, while payout ratio is at healthy 43%. They also have been slightly reducing the stock available in the market over the last 5 years. At the moment, I'm not currently buying Louis Vuitton stock as I find it too risky, especially since other stock we will cover offer better potential returns. So let's continue with Pfizer. Pfizer has a buying price of $22. However, before going further, I want to highlight that Pfizer might be a value trap. Once the stock price reaches $22, I would revisit it to reassess the situation. If my thesis at the moment remains unchanged, I might purchase the stock. Now, if my thesis is correct and we decide to buy the stock right now at around $26, then the expected return would be 4% per year, based on stock price movement alone, or 10% if we include dividends. The problem is with the dividend itself. While the dividend yield is high at 6%, the dividend payout is unsustainable, and I don't see this improving anytime soon. A dividend cut seems likely, and that could further drag the stock price down. Lastly, buybacks are at 0.8%, which is something I like to see. Next up is GSK. GSK has a buy price of £13 and currently is trading at around £14. If we were to buy it now, the expected return based on stock price movement would be 6.5%. Including the dividends, the return jumps to 11%. This makes GSK an interesting investment if they execute their strategies effectively. Speaking of strategies, they are entering markets with new drugs, which creates opportunity for better revenue growth and higher income. However, this comes with risk. If the drug don't get approved, there might be a significant downside. Overall, I believe the stock is a buy right now compared to Pfizer and Louis Vuitton. However, there are a few things I don't like. For one, GSK isn't buying back shares. The shares outstanding did actually increase by 0.6% on a yearly basis over the last 5 years, which is not a great sign. And while their dividend track record isn't terrible, it's not exactly perfect either, which adds some hesitation. Currently, the dividend yield is at 4% with a payout ratio of 47%, which looks sustainable for now. Next up is ASML. At the moment, I don't see ASML as a good stock to buy, as it needs to fall 60% to make sense. That's quite a drop, which is why I'm not investing right now, as I am projected to lose almost 9% on a yearly basis if my assumptions are correct. The dividend yield is below 1%, which they can afford. While there are share buybacks, I am unsure if they are a wise decision for the company right now because of these high stock prices. For now, I'll pass on this stock. Next, let's talk about Kering. Kering is a bit of a mystery for me. I can put the buy price at 250 euros and the current price is just below it, meaning if bought now, the expected return based on stock price movement alone would be at 8% or 40% with dividends included, which is not bad. But if the Gucci division under-delivers, as the slowdown is already underway, and they fall to pre-2017 revenues, which is unlikely, then the stock price should rather be at 125 euros. Please let me know what your thoughts are on this one. But there's also a potential, especially considering the 5.5% dividend yield, which at the moment is well covered. But in the past, we already saw dividends cut from them, so this is something we need to keep in mind. Still, a bit of a wait-and-see situation for me. Buybacks are at 0.6%. Moving on to Dollar General. Dollar General has a buying price of $70, but it's currently trading at 81, showing a 14% downside to my target. If bought now, the expected return would be at 5% from stock price movement alone, or 8% with dividends included, which is not sufficient for me to consider it. The dividend yield is close to 3% with a payout ratio of 31%, which seems sustainable. Dollar General also decreased the shares outstanding by 3.8% on an annual basis over the last 5 years, which is the highest percentage of my list. So Dollar General is not worth buying right now unless it gets closer to my target, but it's worth keeping an eye. Let's keep going with Dollarama. Dollarama has a buy price of $50 and the current price is 100, meaning it's 50% above my target price. If I bought it now, the expected return would be at -6% per year, and dividends don't change that. The dividend yield is very low at only 0.3%, and the buybacks are there at 2.7%. For now, Dollarama is no-go for me, and it was mainly made to compare it to Dollar General. Next up is Estee Lauder. Estee Lauder has a buy price of $30, but it's trading at 84, so again a stock that is highly overvalued in my eyes. 62% to be exact. If I bought it now, the return would be -12% per year or -9% with dividends included. While the dividend yield is 3%, the payout ratio is unsustainable at 244%, meaning a dividend cut is likely if this persists. Buybacks are there, but only at 0.5%. Estee Lauder is far from my buy price, so I'll pass it for now. Next up is ADM. ADM has a buy price of $50 and it's currently trading at 53, which is only slightly above my target price. If I bought it now, the expected return would be 8% per year based on stock price movement alone, or 11% when including dividends, so not a bad return. This is also the only stock that I'm building the position in. ADM has a dividend yield of 3.4% with a payout ratio of 26%, which seems sustainable. But I have to point out that the revenue and net income are expected to decline in the following years, but nevertheless the company remains a sound investment for me, and dividends should remain covered. They also have a good track record, so I don't expect any problems with future dividends. The company is investing heavily in improving margins and digitalizing production, which is promising for long-term growth. Buybacks are at 2%, which is quite good. I am comfortable holding this stock as I believe this is a solid long-term investment. Next up is Target. Target has a buy price of $95 and it's currently trading at 136, so it's 30% above my target. If I bought it now, the expected return would be barely positive, from stock price movement alone, or 3.5% including dividends. Target has a dividend yield of 3% with a payout ratio of 49%. Which looks sustainable at the moment. They also have a strong buybacks at 2.5%, which could support price growth. They are also expanding and opening new stores. Previous years also had a worse performance due to Canadian stores not performing as desired, but now they are closed, so no impact from there for the following years. That said, the price is currently still too high for me, so Target is a pass for now, but I'll reconsider it if it dips closer to my price. Now let's quickly talk about Walmart. Walmart has a buy price of 35 and it's currently trading at 95, making it 36 above my price target. If I bought it now, the expected return would be negative 10% per year based on stock price alone and also including the dividends. Walmart's dividend yield is at 1% with a payout ratio of 40%, and they have been reducing the number of shares outstanding with a buyback rate of 1.5%. Overall, Walmart doesn't seem like a good buy right now, especially with the stock price at a premium. I'll keep an eye on it, but won't buy it until it falls closer to my target price. Moving on to CNH Industrials. This stock doesn't have a set buy price for me, as it's not worth considering at the moment. The revenue has been falling for the past 10 years and I don't see a recovery coming anytime soon. The revenue peaked at around 2013 and 2014 and has been declining since. They did improve their margins and operating performance, but that doesn't change my mind because the falling revenue is too big of an issue for me. The stock has high financial leverage, which is another red flag. This stock is a no-buy for me, and I do recommend staying away unless something drastic changes and they lower the debt. Next up is Sysco. Sysco has a buying price of $65 and it's currently trading at 81, which is 20% above my target price. If I bought it now, the expected return would be 3% per year or 6% including dividends. The dividend yield is at 2.5% with a payout ratio of 51%, which is sustainable for now. They also have been buying back shares at a modest half percentage point. Sysco is another pass for now, but the stock is very close to a buy and I recommend checking it out, as it might be a buy for someone else. Also, it is worth mentioning that the stock didn't go anywhere for the last 5 years, but the revenue growth is stable. I'll definitely monitor this stock performance in the future. Next is Delhaize and has a buy price of 21 euros and it's currently trading at 32. Making it 35% above my price target. If I bought it now, the expected return would be close to 0% per year, or 4% including dividends. The dividend yield is at 3.5% with a 56% payout ratio, while they have bought back 3.5% of stock each year. For now, Ahold is a no-buy for me, but it's a stock worth monitoring for any dips. Next up is Hermes. Hermes has a buying price of 900 euros and it's currently trading at 2,300, which is a 61% premium to my target price. If I bought it now, the expected return would be negative 10% per year with market and also with dividends. The dividend yield is at 0.6% with a sustainable 36.5% payout ratio at the moment. They also did not purchase any stock. So Hermes is no buy for me, and I will need to see a significant price drop before considering it. This was also our last stock, so thank you for watching. If you enjoyed this video, please consider liking it and subscribing for more content like this. If there are stocks you'd like me to cover in the future, feel free to let me know and I'll be happy to take a look. Hope to see you around. Bye!